If you died tomorrow, how long would your family survive financially? Most Americans have never seriously considered this question. But the answer, and the policy you may or may not have bought, could be the difference between stability and financial collapse. Life insurance is one of the most purchased and least understood financial products in America. Most people buy it because someone told them to. A parent, a financial advisor, a neighbor. But very few people can actually explain what they're buying. Here's the basic premise. You pay a company a monthly or annual premium. In exchange, when you die, that company pays a tax-free lump sum, called the death benefit, to the people you've designated as beneficiaries. Simple enough? But the complexity begins when you realize that not all life insurance is the same. There are fundamentally two types: temporary insurance and permanent insurance. And confusing one for the other is one of the most expensive mistakes you can make. Term life insurance is temporary. You pay premiums for a set number of years, typically 10, 20, or 30, and if you die during that window, your beneficiaries collect. If you don't die during that period, the policy expires and the insurance company keeps your money. It sounds harsh, but that's exactly how it works. Permanent life insurance, which includes whole life, universal life, and variable life, covers you for your entire life. It also builds what's called cash value over time. Part of your premium goes into a savings or investment account that grows tax-deferred. At first glance, permanent sounds better, but the cost difference is staggering. Permanent insurance can cost 5 to 15 times more than an equivalent term policy. Let's put some real numbers on this. A healthy 35-year-old man can buy a 20-year, $500,000 term life insurance policy for roughly $25 to $35 per month. That's less than most people spend on streaming services. The same man buying a whole life policy with the same death benefit could pay anywhere from $300 to $600 per month. That's a difference of over $3,000 every year. Insurance companies will tell you that whole life is a better investment because of the cash value. Financial experts almost universally disagree. The return on investment from whole life cash value is typically between 1% and 3% per year. Meanwhile, the stock market has averaged roughly 10% annually over the past century. This is sometimes called buy term and invest the difference. If you take the $300 per month, you save by choosing term over whole life and invest it consistently over 30 years. Even at a conservative 7% return, you would accumulate over $340,000 in additional wealth. One of the most common questions people ask about life insurance is, how much do I need? The traditional answer is 10 times your annual income. But this is an oversimplification that can leave families dangerously underprotected. A better framework is what's called DIME, which stands for debt, income, mortgage, and education. Start with debt. Add up every debt you carry outside of your mortgage: credit cards, student loans, car payments. Your policy should cover all of it. Next, income replacement. How many years would your family need financial support if you were gone? Most financial planners recommend 10 years of income replacement as a baseline. Then, the mortgage. If you have a home, your policy should cover the remaining balance, so your family doesn't lose the house. Finally, education. If you have children, factor in the cost of funding their college education. Run those numbers and you might find you need $1.5 million in coverage, even if your salary is $75,000 a year. That sounds like a lot. But remember, the insurance is temporary. A 30-year, $1.5 million term policy for a healthy 35-year-old might cost as little as $80 per month. The real risk isn't being overinsured. It's being underinsured and leaving your family to figure out the rest on their own. Here's the part of life insurance that almost nobody talks about. Insurance companies deny claims. According to industry data, life insurance claim denial rates hover between 1 and 5%. That sounds low. But when you're the family that doesn't receive the $500,000 you were counting on, that statistic means everything. What causes a claim to be denied? The most common reason is material misrepresentation on the application. In other words, you provided inaccurate information, even accidentally, when you applied. Did you list your correct height and weight? Did you disclose every medical condition you've ever been treated for? Insurance companies have a 2-year window called the contestability period, during which they can investigate any claim and deny it if they find discrepancies in your application. This is true even if those discrepancies are completely unrelated to your cause of death. The lesson: complete honesty on your application is not just a legal requirement. It's the only thing standing between your beneficiaries and a denied claim. Other common denial reasons include policy lapses from missed premium payments, policy exclusions like certain high-risk activities, and naming issues, like forgetting to update your beneficiary after a divorce. These are preventable mistakes, but they require knowing they exist in the first place. So what should you actually do? Start by getting your own quotes, independently, without going through a single company. Use an independent broker or an online comparison tool. This gives you quotes from dozens of companies at once and forces them to compete for your business. For most families in their 20s, 30s, and 40s, a 20 or 30-year term policy is the right answer. It's straightforward, it's affordable, and it solves the core problem: replacing your income if you're gone. Buy enough coverage. Use the DIME framework. Err on the side of more. Answer your application with complete honesty, every single question. And review your policy every 3 to 5 years. Update your beneficiaries whenever your life changes. Life insurance isn't about death. It's about love. Specifically, the financial expression of your responsibility to the people who depend on you. If you found this video valuable, subscribe to Insure Smart. Every week, we break down the insurance topics that actually matter, without the industry jargon and without the sales pitch. The right information could save your family everything.